Welcome to tonight's Benjamin Botwinick Prize in Business Ethics Award. This is an annual event. It's sponsored by the Bernstein Center for Leadership and Ethics at Columbia Business School, and is awarded each year to an executive who shows real leadership in the field of social responsibility and business ethics. This evening we are going to give this award to Barbara Krumsiek. Barbara is the CEO of Calvert Investments. She has had a long career in investment management, starting with Alliance Capital Management, where she rose to be a managing director with about $17 billion of mutual fund and variable insurance products, when she moved to become CEO of Calvert Investments. And during her tenure, she has established Calvert as a globally recognized leader in the field of sustainable and responsible investing. She serves as co-chair of the United Nations Environment Program Finance Initiative, which is a partnership between the United Nations Environment Program and 200 financial institutions around the globe mandated to develop and promote the links between sustainability and financial performance. She has advocated frequently for issues relating to the advancement of women in business. She serves on several private and nonprofit boards, including Girl Scouts USA. She has got many awards and citations for her leadership in business, and holds master's and bachelor's degrees in mathematics and 2 honorary doctorates from Georgetown University and American University. So please welcome Barbara Krumsiek. And Barbara, it is a pleasure to present you with this evening's award.
Thank you. There actually is. Thank you so much. Oh, my name's on it. Now I have to live up to it. That's right.
The name's on it and a pre-hurricane date, I'm afraid.
October 30th, yes. Well, thank you, David, so very much for that introduction. And thank you for coming. This is the rescheduled opportunity for me to speak with you. And what an adventure, and for many a tragedy of Hurricane Sandy. But hopefully all were safe and restored. And things seem to be getting back to some sanity, but New York was really hit hard, along with New Jersey. So I was certainly thinking about you all, and happy that we rescheduled this so no one had to brave these elements. I'm so happy to have some friends here and colleagues. Not my husband, unfortunately, couldn't make it tonight. He was ready to come on October 30th, but the rescheduled date didn't work. I'm very proud to receive this honor, the Botwinick Prize for Ethics in Business. I'm very proud on behalf of Calvert, an investment firm. We were founded in 1976 on the principle of right livelihood. We were not founded as a socially responsible investment firm. We were founded on an ethical principle that there is a right way to do business and a right way to treat your customers and treat your employees. We've become a leader in impact investing and advancing corporate social responsibility. But I personally thank you too. This acknowledgement of my work is very gratifying, and also, as I said, acknowledgement of Calvert's pioneering efforts in impact investing. In many ways, this field was defined long before I arrived, David, as CEO in 1997. But like many fields, leadership is earned every day. I mean, it's brand is not something that you can rest back on. And I look forward to taking your questions, perhaps on that and other areas of your interest. It's also an acknowledgement of all the associates at Calvert, and my colleague Lynn Ford, who heads distribution, is here with me today. We have collaborated over the years with many organizations. I met someone earlier, World Wildlife Foundation. It's important to us to promote environmental stewardship, transparency and governance, and gender equity in America's boardrooms, just to name a few of the areas of focus. So this really award is shared with many. It's fun and good to be back on the Upper West Side. I am a native New Yorker, and in fact lived for 7 years on Riverside Drive on 111th Street. When I was in my 20s, I attended graduate school at night at NYU's Courant Institute of Mathematical Sciences, while working full-time at Equitable Capital, which was acquired by Alliance. It subsequently acquired and now part of Alliance Bernstein, which is Stanford Bernstein Center, so there's a nice circle there. I would actually use the math library here at Columbia as a study venue, back when you didn't have to have ID to get in. And I think many of you now study at Starbucks and other internet-ready and caffeine-laden sites, but back in the day, a quiet old school library was just the place to study math. So despite the challenges of working as an analyst by day and a math student at night, I made it through, and I have very fond memories of the Columbia campus and this Upper West Side neighborhood. I applaud you for being part of the Bernstein Center. I have studied up on your mission, and it resonates with me personally, aligns with Calvert's view of business and society, that you promote ethics in the curriculum of business schools and conduct research on ethics, leadership, and governance, recognizing that ethics is not a siloed area of study, but in fact needs to be infused throughout business school education to prepare you for leadership in the global corporate sector. It's not about not doing bad. You know, ethics has migrated to the role of leadership and governance for the promotion of doing good. These are very powerful concepts, and I think your websites express them very clearly. But what's really challenging is to execute on them for you as individuals, for corporations, for boards, for investors, and for policymakers. So I have 3 parts to my comments this evening. I've been given half an hour, but we took 10 minutes of it chatting, so I think I'll take 20 minutes. And then we'll have a half hour for questions and then some food. But the 3 things I want to talk about first, I do want to do a bit of defining of impact investing and Calvert's view from a business sense, what we mean by that and how we unfold it at Calvert. Second, I want to provide some thoughts on ethical issues that I've faced in my career. And third, I do want to close with 5 reasons why I'm encouraged about the future, despite the daily dose of dour headlines about the global economic slowdown, the impending fiscal cliff in the US, potential global meltdowns beyond Greece and Spain, perhaps in Asia. Very uplifting topics in the paper every day. But I have 5 reasons why I'm encouraged, so I'll share those at the end. But first, impact or sustainable and responsible investing, and the terminology has really been evolving in this space. Calvert used the expression impact investing over 30 years ago, and now it's sort of new and being used again. But in its simplest terms, I think impact or sustainable investment means pursuing multiple bottom lines concurrently. Some say double bottom line, some say triple, but however you count it, profit, people, and planet are all elements of the impact investing equation. Calvert, like any professional investment firm managing mutual funds, seeks out good quality investments that we believe can deliver above average returns for shareholders. But in order to arrive at our decisions to invest in these companies, we analyze how companies are doing business, not just the financial results that they're delivering. Some of our strategies will look for positive practices in companies, for social change and community involvement. In some cases, we exclude companies in some of our products, companies that might be engaged in conduct or products that we cannot support, perhaps tobacco because of manufacture of tobacco products, weapons, or because of the way business is conducted. For example, doing business with governments, doing business with companies that are doing business with governments that are egregious human rights violators. You may not know that in 1982, Calvert launched the first mutual fund that would not invest in companies doing business in South Africa. At the time, a very bold move. It became a powerful tool against apartheid divestment over the succeeding decade. But Calvert at the time was the first to launch this. And this really hit home for me. It was before my time with Calvert, but in 2000, one of my sort of highlight moments as CEO of Calvert came in the year 2000, and President Clinton was still in office, and he was hosting Thabo Mbeki, the president of South Africa, who succeeded Nelson Mandela as the second elected president of South Africa. And I was out of the office actually volunteering downtown Washington. We give our associates a day off a month to volunteer. I happened to be out of the office. And one of my associates called me and said, "You better get back here. The First Lady of South Africa, her people called and she wants to visit Calvert. She's in town for her husband's first state visit with President Clinton as president." And I said, oh my gosh, grabbed my high heels from the back of the car, because you always keep them in the back of the car, and raced back to the office and got there in time. We spiffied up the conference room on 10th floor, before your time, Linda, and greeted the First Lady of South Africa and her entourage. And she visited with us for several hours that afternoon, to the point where at about 5 o'clock I said, excuse me, but don't you have a state dinner to go to? I really did say that. And she said, oh, I'd much rather be here. She was very interested in Calvert. She, of course, was imprisoned as well in the 80s, but was very aware of Calvert's leadership work in that area, and how very, very important that was for Calvert people to have that moment. Let me turn now to the positive attributes we look for in companies, because we do some exclusions, but we are increasingly looking for ways in which we can favor companies that are, for example, I'll give 3 examples. We look for companies that are recognizing current and impending scarcities, for example, in water and other essentials, and are therefore actively engaged in conserving resources. We favor companies that treat workers fairly. We look at lawsuits, liabilities, personnel practices. We favor companies that promote women and minorities and include diversity as a significant positive in senior leadership and governance. And when I say we favor companies, I mean we believe these factors are part of the investable premise in making our investment decisions, and that these are companies that have a higher probability of delivering sustainable profits, not just trading profits, not just profits driven by short-term forces. Increasingly, this integration, it's called, of sustainability research with financial research is becoming the norm. And I don't think they teach it yet in business schools, but I think that day is coming. Maybe some of you will write the curriculum. Maybe it's on its way. Impact investing is a relatively new or recycled term, but in my mind, it is a term that serves as an umbrella concept over a spectrum of investment paths. And it's all about weighing the degree to which we weigh financial returns or impact returns, social returns. If you think of a charitable investment, you might think that's a fully impact investing, or no financial return, full social return. And then you might look at the other end of the spectrum, and what I might call mainstream sustainable investing, where financial returns at market level are the objective, with sustainability criteria satisfied concurrently. And that's what Calvert does. We do them simultaneously. We focus on managing mutual funds and portfolios invested in listed securities, domestic and international, stocks, bonds, money market instruments. But impact investing can apply to real estate, hedge funds, private equity, venture capital, on and on. And at the Calvert Foundation, for example, of which I'm a board member, but it is an independent foundation founded by Calvert, we focus on investing to end poverty. We raise capital through investors to invest in debt instruments that fall a bit on the spectrum between pure social return and financial return. We do offer, through the Calvert Foundation investment note, a modest interest rate to investors. Right now we offer 0.5%. That's not so modest if you go to a money market fund and get 1 basis point. 50 basis points can seem very attractive. But that note is backed by the debt of community development institutions and microfinance institutions across the US and around the world. Well, let me come back to that word concurrently. When I joined Calvert 15 years ago as CEO, and at the time, coming out of Alliance for virtually my entire career prior to that as a managing director, I was considered at the time to be the first conventional Wall Street executive to lead a sustainable and responsible investment firm. And most firms were led by their founders, who tended to be found their companies in the 70s and were driven by whether it was a values-based founding or a religious-based premise. The interesting thing is that I didn't see myself as making a great leap in career. I thought and I did not do sustainable and responsible investing at Alliance. I ran businesses, but for Alliance, mutual fund businesses, but I always thought of Calvert as doing this other thing over here. So when I was given the opportunity to be considered for this CEO role, I studied what was going on with SRI and felt this was really an investable premise. This is quality of management. I was very closely associated with a growth equity team of managers at Alliance and had built my career as an analyst with them and then a business manager. And the one question that I didn't pick stocks, but the one question the portfolio managers could not answer for me to my satisfaction was they would tell me that quality management was one of the key things they would look at, as well as earnings potential, product development, markets, et cetera, capital investment, the balance sheets, income statements, but they would say quality of management. So I said, well, how do you tell that? How do you assess that? And the answer was pretty circular at the time. This is going back, but the answer was, we look at the financial results delivered by the management team. And I'd say, well, wait a minute, we just kind of did that. And it seems circular. I listened to Calvert in being approached to be considered for this job, and I said, this is quality management. How do leaders manage their workforces, manage the human rights issues at overseas factories, environmental footprint, governance? This is all quality of management because it doesn't show up in the stock price the next day. But it will at some point if poorly managed. So I really came to this position saying that I didn't see the either or question in sustainable investing. Either you deliver financial returns to investors or you deliver some kind of social or community good. I didn't get that. The word concurrent made sense to me. Why can't you do both at once? Why is it a give up? Why can't you be developing your company, your products, your operations, so that these goals are accomplished simultaneously? So, as investors, we consider the sustainability track record of a company as material to the investment process. I viewed and continue to view environmental stewardship, workplace practices as proxies for quality of management. And increasingly, the academic literature is catching up with this. I will admit, we don't get paid to do research. We hope some academics, we support a prize every year called the Moskowitz Prize for research in SRI, and we hope faculty gets involved in that, and students. We need more academic research. But last year, CalPERS asked Mercer Consulting, CalPERS is the big California pension system, they asked Mercer Consulting to examine the academic literature on ESG and performance and aggregate the results. Mercer found that of the 36 studies it reviewed, 20 of them showed a positive relationship between ESG, that's environmental social governance, factors, and financial performance. Positive. In other words, do better financially when you consider these factors. 13 were neutral, and only 3 demonstrated a negative relationship. So increasingly, the sustainable investment performance results are comparable, removing one of the most commonly held objections, which is coming out of old school University of Chicago, and I'm sure you all don't believe it, which is that all you have to consider is the financial returns, and everything else falls into place, but it doesn't. We believe ESG factors can, in essence, be proxies for risk management, for good governance. There's growing evidence to support this. There's another paper that's going to be published soon. We did get an advanced look by the University of California, Berkeley Haas School of Business that concludes that there's a positive relationship between women on the board of directors and the corporate sustainability performance of a company. The researchers looked at 1,500 companies, and they concluded that companies with more women on their board are more likely to proactively address environmental risks embedded in financing decisions, proactively manage energy efficiency of operations, provide strong employee benefits and performance incentives, and proactively manage human capital development. There's growing momentum among asset owners, and asset owners are pension funds. They're the ones who, we are asset managers, but the assets are owned by others, that they expect their money managers to bring ESG analysis into the investment process, and that companies that disclose the factors that contribute to ESG performance, that's increasingly being asked of money managers in the selection process for money managers, called RFPs, request for proposal. We're also seeing the emergence of increased reporting standards on these non-financial metrics in a company. Two to point out, one is a voluntary reporting standard called GRI, Global Reporting Initiative. And similarly, integrated accounting proposals are being promoted. And we do have a board member of the standards board for the integrated accounting principles. Our CFO is actually participating in that, and he is a CPA. So we're expecting that this is something that will move forward and would be very positive. Why? Because we as asset managers, we need data, we need information, and we need it reported consistently. we can't have companies determining their own disclosures because it makes it very, very difficult for us to then compare, contrast, and also make wise investment decisions. It's been said that 50% of S&P 500 companies now produce voluntary sustainability reports, most according to GRI standards. The second example or trend, that's not my phone, so I'm okay. It's a good ring.
Quite common. Could have faked it.
The second reporting trend I want to, and it's really more of a collaborative trend. I don't know how many have heard of the work of the UN. I'm very involved through the United Nations Environment Program Finance Initiative. And that organization several years ago launched the UN Principles for Responsible Investment, or PRI. It was founded in 2006, a network of asset owners, but also of institutional investors, including Calvert, who recognize that ESG affects the performance of investment portfolios. The principles provide a voluntary framework, again, where asset owners can affirm their support for the incorporation of ESG issues into their decision-making and ownership practices. We signed the principles in the year they were launched. There are now, I believe, about 1,000 signatories, representing over 20 trillion in assets under management. So you might say, well, if you've got 20 trillion in assets under management, asset owners who are saying they want to see this happening, is it indeed happening? Well, no, it's not yet being operationalized. This is an aspirational commitment that is not yet being operationalized. In other words, these asset owners are not yet demanding that their investment advisors incorporate ESG across all investment processes, but it seems inevitable to me. It also seems to me that this is a job opportunity for MBAs because there are lots of aspirations out there without a lot of people who know how to implement them. And for those who have an interest in advancing this type of investing and this field, I think we're not just going to see asset management firms, but we're going to see asset owners and corporations increasingly need very wise help in implementing ESG and infusing it within their organizations and making it part of their practices. Sustainable investing is at a tipping point. And I think Calvert's business challenge in the next few years will be to effectively compete with an entirely new set of firms who have overlaid or integrated ESG into their investment organizations. And I'm not talking about the traditional SRI managers. I'm talking about the BlackRocks and the Axes and the large asset managers who are starting to bring this into their operations. We believe our authenticity, heritage, and brand give us a starting advantage, but we need to continually demonstrate strong investment performance and new product offerings to meet what I believe will be a growing demand for impact investing capabilities. Now, the second area of my remarks, I wanted to muse a bit about ethical issues I've faced in my career and my life experiences and what it's like to lead a company that incorporates ethics and integrity as an integral part of its brand and mission. Boy, it's a heavy responsibility. This is not quite an ethical issue, but when I joined Calvert in 1997, my daughters were 5 and 8. I was a working mom, married. My family relocated. My friend Fran, my old friend Fran, is here from New York to remembers those days, I'm sure, when we took off and left New York. Yeah, still sad about it. Still sad because we live in Washington now, which is where Calvert's located. But here I was joining a company that had its challenges with earnings, had its challenges with sales and growth and products and investment performance. And the single thing I was most scared about was that here was a company that for the last 5 years in a row had been named one of the 100 best companies for working mothers with a man as CEO. And I was most scared that we would not win that award the first year that I was in charge, but we did. Thank goodness. I was really worried about that. That's more an image concern, not so much ethics. It would be great if ethical dilemmas presented themselves as ethical dilemmas with a big sign flashing, say, now, ethics, okay, integrity. Careful of your choice here. But we know they don't. They sneak up on us. And the rearview mirror seems to be the only true test of whether that was indeed an ethical choice. We may be facing practices and concepts that everybody does. Everybody does it. It's ordinary practice. We may be facing gray areas, which is very, very frequent. I tell Calvert Associates that we We develop codes of conduct. We develop compliance programs. I personally must sign 6 different codes of ethics because I have them for every company I serve on and every subsidiary I'm part of. But we cannot write enough codes of conduct and ethical codes of ethics to cover the hundreds of ethical decisions that Calvert Associates make, and I know each of you has made and will make every day in your working life. Our associates make decisions on behalf of Calvert that have ethical content at all times, and they cannot possibly be covered. We can't hire enough lawyers. I guess there'd be enough lawyers to hire if we wanted to, but we don't want to hire enough lawyers to cover every rule. And I am not a fan of regulation. I don't. My tone at the top for Calvert Associates is that I have to trust them to act ethically at all times and in all circumstances, including those not addressed in the formal code of ethics. To me, a code of ethics ethics comes from your heart. It doesn't come from your head. It comes from your values and not from the written word. You know, how do I demonstrate, you know, my trust to Calvert Associates? I think I have to do that by trusting them, and therefore I have to demonstrate that I will trust them, and they will hopefully honor that. And frankly, if they don't belong at Calvert. But just a couple of things I do. I mean, on a quarterly basis, I share the board report that I give to my boards in every detail with Calvert Associates at all levels in the organization. There's no shortcutting, there's no shorthanding, there's no summarizing. They see everything that's going on at Calvert. The 2 things they don't see are M&A activity, and they don't see personnel decisions. But other than that, they see everything. And I tell them that, you're seeing everything. And that's honoring them and respecting them, and hopefully they do the same in the decisions they make every day. I also mentioned the pay. Did I mention to you that we give 1 paid day off a month? I mentioned that because I mentioned I took one. Well, that program is on top of their vacation, our vacations time. And while an individual has to request the day to volunteer, whether it's a Habitat for Humanity Day, or we do a lot of Foods and Friends delivery. I think they have something like that in New York. But we don't check back and make sure they did it. We don't require individuals to submit a photo evidence or some report on what they did. And I was once on a panel with some CEOs, including at the time the CEO of MetLife, who said to me, "You mean you don't check up on that? What makes you think they're not out there playing golf?" And I said, "Oh my gosh, yes, you have to trust your employees. You have to trust them." And very honestly, it's such a valued benefit too. I do think anyone taking advantage of it, again, does not belong at the company. But I do think ethical decision making is something that has to be intrinsic in the way you think about everything you do. It's not, again, not in this circumstance. I'll give an example of a situation I was confronted with while a managing director at Alliance. I was responsible for several product lines in the mutual fund area. We managed about $17 billion, as has been mentioned. And these were all part of retirement savings programs for individuals, 401k plans, 403b plans, annuities, as well as wealth management products for individuals and institutions. The trading or brokerage costs for managing these portfolios could be substantial. You can imagine the turnover in these portfolios actively managed, and even at 2 or 3 cents per share, and back in the day it might have been 4 cents or 5 cents. Costs were in the millions of dollars in these portfolios. It was our duty as fiduciaries to trade these securities with brokers at the lowest cost for best execution. And I took that very seriously. I was approached at one point by a salesman, a new salesman, who joined our company. Did not work directly for me in our sales area. He's no longer with that company, but he pressed me to have our portfolio managers in my businesses direct their trades to certain third-party broker-dealers who would then allow the salesman to sell more product through their system of financial advisors. This is called directed brokerage. It was not an illegal practice, not necessarily an uncommon practice, but not a universal practice. We were not using this practice at the funds in my business. We were trading through many different broker-dealers based on lowest cost for best execution. I did ask what the benefits were to the shareholders in this practice, and certainly there were benefits to the salesman, who'd make more money, sell more product. He argued there were benefits to the company for growth in bringing in assets, and I guess someone could argue, well, if in a mutual fund you get more assets, that can be a positive. but I could not be convinced that the shareholders in my products would benefit from this practice. Certainly this was not an easy decision to make. I could be thought of as not being a team player. This was being done in other parts of the company. I felt it was the right thing to do, stood my ground, and it was respected by my leadership team. I relied on my sense, my gut, that said the first priority was the good of the customer. And sometimes the good of the firm is a driver to determine what the good for the customer. I mean, customers are not served by companies that go out of business, I'll tell you that. They're not. So, there are times when you make decisions that have to serve the good of the company, and also you believe in the long run serve the good of the customer. But I didn't think that applied in this case. So a decade after this encounter, in the 2000s, this practice was actually called out and no longer permitted. This is part of the late trading and market timing scandals of the mid-2000s. Directed brokerage was a practice that's no longer permitted. Did I feel vindicated? Yes, in a way, but also I felt most reinforced that making decisions is on the spot, and it's a combination of gut, and it's a combination of analysis and your gut feel about what's right and your confidence. And sometimes we give in to one or all of them, and I think confidence can be shaken by our peers, by the maybe being considered on the outs. And again, this wasn't an earth-shattering decision. It wasn't putting my job on the line. But there are people who put their jobs on the line for the decisions that they make. What I think it was felt was that I was putting on the line the profitability of my business. But you know what? We grew anyway. We grew faster, and we made more money than anybody else anyway at that time in that company. So that's what it was felt, that I was making a non-financial decision. But it turned out, we did well. I do want to sort of move for my final comments so we have time for some questions. Why am I encouraged about the future? 5 months ago in June, I had the opportunity to participate in the Rio +20 climate conference. Do you remember that conference? It has fallen out of the headlines. It didn't make a whole lot of headlines. But it's not out of my thinking about the future. And I was there as the co-chair of UNEP FI, as part of the public-private part of the conference. And for those who didn't blip your radar, Rio +20 was a follow-up to the Rio Earth Summit in 1992. That's when Al Gore discovered climate change. The first Rio conference concluded with nearly all of the world's government leaders signing treaties to manage climate change and protect biodiversity. It was an historic moment, followed by the development of the Kyoto Protocol that grew out of that conference. Yet these agreements have had very little effect. I mean, witness Hurricane Sandy. I'm sorry, I'll just put my little spin on that. Worse storms, tough storms, flooding. In the last 2 decades, we've done almost nothing to slow climate change. Carbon dioxide emissions have nearly doubled since 1992. Subsequent global climate meetings in Copenhagen and Cancun have produced little in the way of binding agreements. And for some observers, Rio +20 seemed like it was going to be more of the same. But yet, I'm optimistic, and it comes from five observations, all driven by the fact that the private sector, for the first time, was there in very significant numbers, and civil society groups were there in significant numbers, and we intersected with the government agencies, the investors, for-profit, not-for-profit organizations in a very dynamic conference. 5 initiatives worth noting. The Green Economy Initiative, increasing awareness and support for a green economy initiative and how to finance it. We're exploring ways that businesses, governments, and communities can work together to foster sustainable economic growth. How do we grow our economies while providing employment, reducing poverty, all the while cutting carbon emissions, conserving resources, and protecting our environment? Who saw Governor Pataki in an op-ed today? I think it was in the Washington Post. For anyone who remembers him, he was a Republican governor back in the 2000s. He's talking about sustainability, and it's unbelievable. It's just, it would not have been in his vocabulary 10 to 15 years ago. Companies are doing very innovative work in this area. Puma was on one of the panels. They're measuring their environmental impact, and they've cut, I think it's unbelievable, 145 million pounds of, I don't even know if it's measured that way, greenhouse gas emissions. But they're actually assigning an environmental metric to every one of their business lines, and assigning reductions in footprint to their business lines. Puma aims to use sustainable materials to manufacture half its products by 2015. Siemens was on one of the panels. They offer green technologies, allowing customers to cut carbon emissions to date by 317 million tons. That's more like it. And that's 1% of total global carbon emissions that Siemens takes some credit for. Yet this green economy has to be financed. That's where we need more firms like ours, more investment banking firms, organized towards this, and governments need to chip in. We need capital. Private sector may provide up to 80% of it, but we need collaboration, tax policy considerations, and we need to work together to get this green economy moving forward. The second element that I was very pleased with is the Natural Capital Declaration. To date, Earth's natural assets, including soil, air, water, plants, and animals, are called externalities in an accounting sense. They don't get into the calculation about financial risk and return. And that I believe, is on its way to being changed. We launched the Natural Capital Declaration, asking us to value these impacts and incorporate them into our investment analysis. Calvert has been supporting this by including language on biodiversity in our proxy voting guidelines and encouraging other investment companies to do similarly. 3, measuring results. I brought that up as an area I'm very hopeful about. Increase in sustainability reporting. Half of the S&P 500 are reporting according to GRI standards, but KPMG says that globally, 95% of the world's largest 250 companies now meet GRI standards for sustainability reporting. And that's up from 83% in 2008 and 45% in 2002. This is taking root enormously outside the US. I will say I was one of the few US representatives at the Rio +20 private sector conference. I do think there's room for the US to be much, much more engaged and much, much more active, and I'm hoping this group will be part of that. The fourth positive trend, impact investing. It was a standing room only panel that I participated in at Rio +20, where we talked about microfinance, development finance, private equity firms, and through our foundation we are investing in community economic development and offering the ability to invest in this from as little as $20 to $20 million in community-based projects around the world. We do have $200 million invested in 250 community organizations in all 50 states and over 100 countries. One of them, it is really to assess the impact of this work. Again, our foundation develops these metrics, but we've allowed for the rehabilitation and building of 17,000 low-income housing units. We've created 430,000 jobs in the US and developing countries and financed over 25,000 cooperatives, social enterprises, and community facilities. And these are small dollars, 200 million, but they go a very long way. And my last positive is the one I'm most passionate about, governance and board diversity. Increasingly globally, a focus that corporate governance and board oversight and diversity go hand in hand. There were 2 panels in Rio devoted to the role of women in advancing better governance and sustainability improvements. I'm quite honored to introduce one of my mentors who I've looked up to for many years, Amy Augustus, who's one of the founders of the Women's Economic Roundtable, which was the organization, in essence, the economic club for women, when the economic club would not allow women into the economic club, and that wasn't that long ago. It was perhaps in my lifetime, I guess, back in the 70s, but Amy was one of the founders of the Women's Economic Roundtable, and there has been such great progress for women, but there is still a lot further to go, and this is an area that I personally devote a lot of time to. Growing body of research shows that including women at all levels in the corporate structure enhances financial as well as sustainability results. McKinsey's study found that companies that had at least 3 women on their senior management team outperformed their peers significantly on a broad group of management excellence measures. And another favorite study of mine out of the University of North Carolina, some of you may be familiar with the Lilly Ledbetter legislation. It was the very first legislation passed when President Obama took office in his first term. And that's about pay equity. It's been one of the most stubborn, statistics in my working lifetime, which is that women doing the same work at the same level of experience and the same performance, I believe the aggregate statistic may be 68 cents on a dollar in aggregate. And that's maybe moved up a little, but not a lot. And the Lilly Ledbetter legislation is very onerous, I'll tell you, in implementing it in our company. It's costly to implement it, but it is working toward to assure that pay equity practices are followed. But my favorite study at a University of North Carolina looked at 2 million working women. It didn't look at employment practices and policies within companies. It looked at women who were working and surveyed their salaries and compared them to the salaries of men and the entire workforce. And what it found was that pay equity rose to over 90 cents on a dollar in those companies, and these were women that worked for public companies, in those companies where there was a woman among the top 5 paid executives in the company. That is a disclosable, as you know, those who have studied proxy statements, you have to disclose your top 5 paid executives. And where there was a woman, the pay equity rose. Now, is that because women were running HR? No. It's because the awareness level's up. Could have been a CFO, could have been a head of marketing, could have been, frankly, a CEO, although there are more of those, but there weren't that many. But wasn't that fascinating? And what I would challenge corporations and boards is, you're spending all this money to comply with Lilly Ledbetter. Do you have a woman among your top 5 paid? Because that's what correlates, you know, if you run the company in a I think, ethical, logical manner and take advantage of all the talent, you may actually avoid some costs, some compliance costs. Well, I do want to conclude with the unifying theme that I believe finance is part of the solution. We're not part of the problem. We're part of the solution. We can raise and invest capital to fund renewable energy, water, and food for all. We can hold companies accountable for achieving their sustainability goals through rigorous analysis and monitoring. But to play this role, we need more executives and future executives who are willing to stake out a higher moral ground, stop putting short-term needs ahead of everything else, stop taking advantage of customers, or even coming close. When in doubt, don't do it. We need to instill and refresh continually a sense of values, a sense of purpose in our financial institutions, a culture in which every employee thinks about what's right for the customer, and we all make decisions every day, all day long, about how to build better long-term relationships with people who buy our services. I'm so impressed with the Bernstein Center. I'm so thrilled that you are here and that you are bringing into your graduate studies an infusion of ethics and responsible practices. I know you'll bring this to your future employers, and I know that they're going to find that of value to them. You're going to help us build financial institutions that value moral sense and you'll be rewarded for doing well and doing good. Thank you for your time, thank you for attention, and for this very great honor. Thank you. I'd love to take questions. I don't know how much time we have. David, are we 10 minutes? Okay, we got 2 hands. So start in the back and then here.
Sure. So, thank you. My name is Eric. Quick, 2 common questions. So the first point you made was around, one of the first points you made was around women in the workforce, and talking about women on board, leading to higher scores in terms of environmental and social metrics. Surely that's a little bit circular, though, because a company that's interested in trying and working to achieve gender equity in the workforce is therefore, part of that is the human capital side and all the other environmental and social things. So that's more common. The question, though, as a South African and who appreciates the divestment work that was done in terms of pathway and so on, the question is Calvert actively pursuing any other divestment campaigns? There's more and more of these campaigns around the world, Occupy Tibet, Occupy Palestinian territories, etc. Are they doing any of those?
Well, there are several countries that we will not invest in companies that do business there. And Sudan is one, and Burma is another, although we're actually looking at Burma again with the, you're not there forever if the practices change. But we don't actually do campaigning. I mean, we do it through our investment work. We get asked that a lot about being activists. We're activists, but all in the context of the investment portfolios and delivering value to the shareholders. Was that your second question?
Yeah.
Your first one, you know, I'm not sure I agree it's circular, but I think there are companies that, 25% of companies don't have women on their boards. I mean, it's amazing. It's an amazing statistic to me. How can that be? And most others think one is enough. And I always say, what makes one the right number? I don't know. Is there a magic to that there's one? We actually developed a model nominating committee charter about 8 years ago and sent it to several thousand companies on a letter that was signed by me, but not really, because somebody sent them all out, that said, we'd like you to adopt this charter, and all it said is interview women and minorities for every opening on your board. And it actually helped in those next 2 or 3 years blip the needle for women about 2 percentage points. But it stagnated again about 16 to 18%. So I'm not sure I see it as circular. I would like to feel that it's a movement, but I don't think so. Have you had a hand up here and then here?
Yeah, my question related also to women on boards. And I just want to preface my question with saying that I was a beneficiary for 6 years at Calvert before you joined. I took Community Service Day, but I was allowed to separate. So I actually went to an organization that was in the same town, happened to be headquartered there, and was able to spend 2 hours every week and put my day together that way. And that led to my first nonprofit board position.
Were you with Calvert? Are you saying you were with?
Yes, I was Associate General Counsel.
Oh my gosh, hello. Great. Let's say hi afterwards.
That was actually wonderful because it actually gave me the time to do what I wanted in the midst of the workday while I was doing other amazing things at Calvert because they,
I think you emailed me. Did you email me?
Well, yes, we
you did. I'm sorry.
Okay. College together, we met at
FWA?
Place launch.
At the Microplace launch. Okay, great.
Donated employee.
Thank you. I have a lot of trouble because I meet a lot of people. I'm really sorry, but it's great to
I just
see you.
completed my MBA studies here a few weeks ago.
Congratulations. Wow.
So
Great.
the question is then, and there are
okay, there is a question. Okay.
In management, but
yes.
So I've had those nonprofit boards. I'm even on a for-profit board, but making that leap to a public board is just. I mean, I don't know if there's any advice about. There's no magic. People usually do it by referrals and recommendations
and search firms play a role, and also there are directories being developed. CalPERS, CalSTRS are developing directories because they want to encourage the companies, the companies they invest in through their asset managers to increase diversity. So there are, I think, networks to get into. There's also trainings that are, I think the FWA does a training, and the Women's Forum in New York does a training. And I think you should look into those. Did you have a question?
Yeah, I did.
And
so
I'm
curious about some of the studies and sort of the macro sense of women in boards, like the Haas study. I'd like to know a little bit more about that. But can you talk about a specific instance that a challenging board situation, perhaps, from a personal perspective, maybe when you were on a public board? I mean, if you can't. Okay, full disclosure, I write cases here, so I'm kind of like.
Oh, you do?
Yeah, trying to dig.
I could only talk to you after I'm off the board. I can't talk to you. I am on a public company board. I'm on the board of.
No names, no names. I'm just saying, like,
well, but I'm only on one, so if I told you. I can only serve on one. It's a very common practice when you're a sitting CEO that my board does not let me serve on more than one because it's very demanding. I mean, I was on the audit committee. Now I'm on the finance committee, the comp committee, plus the board. I mean, it's very demanding. So if you're a sitting CEO, you tend not to. But I promise you, you'll get the stories when I'm off. We'll catch up on that. Okay, let me just get these last two questions.
You mentioned in the beginning that you sort of surveyed business schools and the ethical curriculum at each, and you talked about how you try to foster those conversations on campus. What are some of the best practices that you've seen, in those studies, and how do you think we can implement them?
I can't say I've done really serious work on that. It's just an observation about an ethics course versus when you look on the website and see that it's infused. And I probably get invited to those schools that have made it proactive. So I spoke at American University in the spring, and they started the first master's in environmental management. And it was a public policy, environmental science, and finance co-taught or cross-curricular. So very interesting. That is not ethics, but nonetheless, I like their approach. Georgetown University, I spent some time there in their business school, McDonough School. And did I say Notre Dame? Interestingly, Notre Dame has Now, it may be driven by Catholic values, or, but, there are all kinds of values, but they have a high profile on ethics and integrity infused in their curriculum. This is an observation, but I strongly believe it, because when you get out in the workforce, there isn't like the door that says, here's where you go to make the ethical decisions, here's the lab to go ask the questions. It doesn't work that way. In fact, it's rarely talked about except in codes of ethics and compliance and the lawyers. And I think it has as little to do with lawyers as it has to do with shoemakers. It's not about that.
Yeah, you mentioned several times the trust you have in your employees and the ethical decisions they make every day. I'm wondering how you select or hire for this kind of ethical compass, and how us as speakers.
And by the way, we make mistakes too. We wind up with folks that maybe haven't done everything just right. I mean, so I'm not saying we're perfect. We try. It's very hard to test for this. We do some testing, which I think you'll see more and more in companies before we bring people in. But it might be more Myers-Briggs, or sort of understanding what people are all about, what drives them. This is my anecdotal observation, which I've talked to my people about, including in their conversations. It seems to me that I observed after joining Calvert, you can think going into a firm that has as its mission social responsibility, that these are going to be people who are all tree-hugging, animal-loving, et cetera, the whole gamut. And it's not true. It just isn't true. But what is true, people who are successful at Calvert, happy and challenged at Calvert, have something outside of themselves and their work that they care about. It doesn't have to be all 6 things that we care about, indigenous people's rights, human rights, but it's something that they care about. And it was brought home to me more and more that those are the folks that really understand the notion that it's outside the numbers. And that when we're interviewing, and it's a very natural thing to do, we talk about what do you do outside of work, and what motivates you, what inspires you, and if we don't hear things that have to do with sort of your better self, if I could put it that way, doing good in the world, helping others, caring about the planet, if we don't hear something like that, they're probably not going to be happy with us. We actually once had a candidate in our social research department who said this was a couple of years ago, he didn't believe in global warming, but he really felt he could execute on Calvert's policies really well. And I just thought, what is he going to be happy here? I mean, it's just like, so we didn't hire him. But he actually said that. So I think there has to be something that you care about, but not everything. I mean, there are Calvert people that have very different points of view on different issues, but they care about something, and that makes them a right person to work at Calvert. Well, I think thank you so much. Thank you.